don't get into franchising if you're thinking about short-term income. Just don't. Go take a job, buy a cash flowing business already, because that's going to be better. It's going to cost you a lot more on the front end, but there is going to be a ramp up period that is typically longer than anyone anticipates. You've said it multiple times. I've said it. Most of the guests on your podcast have said it. It takes time, and you got to be strategic with your timing on when you're starting to take money out or when you're growing, not emotionally.
Representing Franchise Secrets, Erik Van Horn. The Bobby Brennan, welcome back, man.
What's up, Erik? How you doing?
Great. A little hangry. You saw me eat a protein bar in about 30 seconds, and here we are. I'm energized. I'm ready to go. You?
It's that podcast life.
We're always looking on social media. One of the trends that I'm seeing is people talking more about how hard franchise ownership is. I've been doing this for a long time, talking about how hard it is. I've been talking about like the truth about semi-absentee ownership for many years, because there's a lot of like misinformation out there about that. I'm the guy having conversations with consultants, brokers that are buying into the whole passive franchising thing, and I have emails and text message threads from a number of years ago where they're like, Erik, help me understand this, help me with this. I'm like, don't do it. Don't do it. Don't do it. It's not passive. I haven't seen a passive one yet. And they're like, you don't understand this. It's going to be great. And then like what I love, a couple of years later, they're like, I just lost a few $100,000, $1 million. And then opportunity costs with all of that, but they bought into it. And so they can buy into it. The general public can buy into it. And I see more people talking about how hard it is to be a franchisee, just like being an entrepreneur is not easy. And a post was out again today by someone that talks a lot about this stuff and is a franchisee, and talked about like the myth about passive ownership. Are you seeing that more in general out there about some of the brokers and the consultants and the franchisees talking about the reality of franchising versus the highlights?
Yeah, it's interesting. You are seeing it more, to your point. The thing I've noticed is a lot of the people that are pushing that are ones that have owned these types of businesses themselves. And they're in the trenches themselves. And I think there is this more transparency today than there probably has been in the past about what it takes to be successful as a executive or semi-passive, semi-absentee owner. And to your exact point, the email or podcast that came out today that we were talking about, they talk about if you want to ease into that, great. But it's not always that for everybody out of the gates, and it's hard. And everyone hears these franchisees that have been in it for 5 years, and maybe they're to that point of spending X amount of hours only in the business, or, they've got this many locations, but you got to start somewhere. And it is refreshing to see some of these franchise consultants, brokers, advisors, whatever you want to call them, really lean into that, because a lot of them now have experience of owning business themselves, and it's hard. It's not day one, I've got a huge infrastructure and all these people that I can delegate to. No, like the buck stops with you. And I think them seeing that, in my opinion, has raised awareness to how hard it is. And also, I think franchisors are, during COVID, I think there's a lot of franchisors that sold semi-absentee all day long. You can run this and keep your full-time job. And they're seeing some of the repercussions of people that maybe weren't the right fit or didn't have the skill set to run it, semi-absentee or executive. It can be done, but can you do it? And why are you going to be successful versus others? I think franchisors are also being much more transparent about what it takes. Some brands even requiring franchise owners to be owner operators from day one, and then they can scale out once they hit certain revenue streams or put a management team in place, because specific businesses are harder to run with a general manager in place and keeping your full-time job, whereas other businesses are maybe set up for it a little bit more. So yeah, I'm seeing more in that, but I still see some of those where people are like, oh, start a business on your side hustle, nights and weekends. And to me, like, those are the hard ones to swallow, that it's like, it's going to be way harder than you expect, and expectations are not being set very well.
I was on a mastermind call with my friend in my franchisee mastermind. There was it was just an ask me anything session, and the topic of bonuses, profit sharing, phantom equity came up. So we spent about 30 minutes on that, and it came from a new franchisee in brick and mortar that is in a very good space, like the industry is doing well in franchising, and he's a sharp guy, and he's like, talk to me about like profit sharing. And so I went through a lot of my experiences because I've just had so many experiences with that. And by the way, I roped Jim, our business partner over at Front Street, into coming to do a session in the mastermind on
Love it.
bonuses, retention bonuses, and all that, because he's a genius with that and has a really good perspective. But so I knew like profit sharing is probably not going to be the best for this guy in this particular industry, and most important at this particular time and stage that he's at as a franchisee, meaning he's not even open yet. He's wanting a GM, which is the right move.
Yeah.
He doesn't really know what that GM's supposed to do because he just hasn't experienced it yet. He knows from his mindset what he's been told, but he's never experienced like what does a 10 out of 10 GM, an A plus GM really do. So he doesn't know a lot of that. He's brand new. His P&L is going to be a lot more on the loss side because he's just starting out. And so so then I kicked it over to another member who is very successful, been in it for a lot in franchising for a long time, has an amazing lifestyle, multiple locations with multiple brands, all of them doing very well. And he does profit sharing. And so we started talking about profit sharing. I said, I love that you're doing profit sharing. It's a very simple way that he does it. It's for to bonus employees and whatnot. But then I said, do you think the new franchisee should do profit sharing when we have no idea when he's going to make a profit and how much that profit's going to be? He's like, no, not at that stage. So the point of that is be careful who you're listening to. Goes back to what you were saying earlier. A lot of the content that I'm starting to see out there from consultants, brokers that had success as a franchisee, got involved in some other things that they thought was going to be the easy button. And guess what? It wasn't easy. It wasn't as semi-absentee as they thought. And I have full respect for these people because I was one of them. That's what made me better, is what I thought to be true was not true. And I wasn't the magic picker of franchises. And I wanted everything to be semi-absentee, like the brands that I'd been a part of for several years and had it all figured out and where I could be semi-absentee in it. Well, it wasn't the case with some of these emerging brands that I eventually got involved with. So I learned the hard way, and I see some of these other people learning the hard way, and I see that content out there, and I love it. So any comments on that before we kind of talk about what we see as the stages of a franchisee from an investment, cash flow, financial perspective?
No, I mean, I think you hit it on it pretty well, and it's refreshing. You never want anyone to lose money or learn the hard way, but listen to the people who've been through it. As you're talking to advisors, consultants, whomever, like just understand their background or any advice you're taking. Someone once told me, don't take advice from somebody whose position you don't want to be in. And that's you're at a barbecue and someone say, you're going to open up what business? And I've
Mhm.
went against that decision multiple times in franchising and business, and it's worked out really well for me. But there's also times where I probably should have leaned on some advisors or people that have been in the franchising space or been in the industry, or there's a lot of people that are willing to share their wealth of knowledge, even existing franchisees within these systems. So I encourage people to continue to validate that. And even if someone's kicking butt in a franchise and they are able to run the business in 5 or 10 hours a week or whatever it is, understand what it took to get there, because your journey and your path is going to be different. And same thing with your cash flow, your market, everything's going to be slightly different. And, again, we're going to get into some stuff here, but this episode is not financial advice. We're not making any income guarantees. And you should always consult your franchise disclosure document and financial advisor before making the decisions. But when someone is able to do that, it shows you it's possible. If they're the anomaly of one person doing it, everybody else is full time in the business, you really need to do a gut check and say, am I going to be the 1%, or am I going to be like everyone else? And just having self awareness. That's all I would say. Is I think it's important to just continue to validate. We hit on this on every call, but validate with smart people, not the bottom producers. Validate with the ones whose position you want to be in, not the ones that are at the bottom of the barrel in a franchise system or in other systems. Like, I'll take advice, but I want to make sure, are they top producers? Because that's who I want to hear from.
I've always done that myself. I might talk to an underperformer, but I realize who I'm talking to, and it was through that filter. And I would talk about underperformance, but I would talk about it with a top producer.
Yeah.
And I think that's the difference. And so what you just said is advice that I've been given, advice I've given, and advice that I take whenever I'm, making a new investment as a passive investor into a franchise or really anything else. We are going to talk about franchises in general from what we've seen. We are not talking about Front Street brands that we have been or are involved with at all. This is just, what we've learned about franchising over the last number of years. And really what it came from is Greg Nathan is probably the foremost expert out there on like the franchisee franchisor relationships. He's got a great book from Australia. He kind of came up with the stages of a franchise, that franchisee franchisor relationship. My friend Joe Matthews kind of put it in his book, Street Smart Franchising, but with permission, Joe said. But that's like people, the franchisees go from like a glee stage when they first get into it, and then go through these different stages where they're happy, not so happy. I'm happy again. All my success is because of me. And eventually they get to the stage where they're not blaming the franchisor for everything. They're not taking credit for everything. They are working with that franchisor, and that is a good relationship. And I'll tell you what, most franchisors want that. Now there's some shady ones out there that are not going to be the most helpful with that. But we talk to franchisors all the time. They want that. So I kind of took that combined with like my experience as a franchisee investing, and then what we've seen other franchisors do in terms of helping their franchisees understand P&Ls to come up with the stages of a franchisee, not from a mindset standpoint, but from like a financial cash flow perspective. So
Yeah.
these are all ranges that we're talking about. It depends on the industry. It depends on it's at retail. Is it a truck in a truck? What is it? But the first stage is kind of that investment stage. This is the stage where money's just going out. Like money's going out. You back up the truck, money's just flowing out of that. You feel like, what am I doing? Everything seems to cost more than you think it should, than you'd budgeted for, because most budgets come in on the high end. If they don't, it sure feels like they do. So that is this stage. Like you are in the capital deployment stage. You're not taking money out of the business. This is the stage where you are investing into the business, and not necessarily just from a P&L standpoint, but from a balance sheet. You put money into the business, into the asset. You buy a truck, you buy these different things. You buy a desk, a truck, equipment. That is on the balance sheet, not necessarily on the income statement. So that is that, investment stage. It is also kind of like the balance sheet stage. Negative cash flow. Like you don't have cash flow coming in when we're building out Solo Salon Studios. Like we didn't have cash flow coming in. We signed a lease. We started to spend $1 million to build the thing out. We were paying on the bank loans. We were paying employees that weren't producing any revenue. Everything was going out. And it wasn't until about 6 months in to that, when we were opening up the doors, did we start to see revenue making more than our expenses. Again, that's an income statement deal, not a balance sheet deal. So this is a stage that stinks as a franchisee, as an entrepreneur in general. What else would you say about that kind of pre-cash flow stage?
Yeah. I think I would call it intentional negative cash flow. Like it's intentional that you're building this business. You're building the foundation. And, Greg Nathan calls it the fee stage. We went from the glee stage of signing the franchise agreements. Now we're in the fee stage. You just feel like I'm just putting all this out. And you'd be surprised how many people read the item 7 of the FDD. They read the item 5, 6, 7, all that, and they still question, like, where are these fees coming from? So I feel like making sure there's aligned expectations of not only what is due, but when it's due, really understanding the item 5, 6, and 7 for those first, let's call it 6 months, right? You're just investing, you're just putting capital out. You may not be generating any revenue whatsoever, depending on the type of business you're in. And if so, it's typically fairly small, and you're not good. You're early. It's like starting a new job or learning a new hobby or playing a new sport. It's all brand new. And we've said this in other calls. Like the analogy I give, it's like surfing. First time you go surfing or skiing, whatever analogy you want to use, don't die and don't lose money. Don't get an expensive medical bill. Like you bought a business, not a job. If you're buying a business and saying, well, I need to make this much money my first 6 or 12 months, don't buy a franchise. Don't buy a business, because there's no guarantees. The probability of that is probably low to replace an income in year one. That's why some people want the semi-absentee, back to our comment. But making sure you have realistic expectations that the second and third time I went skiing, the slopes didn't get any less steep or scary. I got better. And you understand what to anticipate your second and third year in business, but you got to make it to the second and third year. You got to make it mentally, physically, emotionally, and financially. You got to be able to make it through those stages. But that first stage is tough for a lot of people. And if they lose momentum, especially in a brick and mortar that might be sometimes 6, 12 plus months to open, you see people lose momentum and they lose motivation. And all of a sudden they've invested all this money and they're no longer motivated. So having realistic expectations is so important at this stage to make sure that they understand like what the upfront burn is going to be, and just have more capital than you need, to Erik's point. Too much money is a very small problem. Not enough money is a very big problem when you're starting a business if you don't have the financial runway.
I think this is when you're paying for training. This is when you're paying for all your licenses. This is when you're paying to onboard new employees. You're hiring employees, and you have to have employees. Then they have to be trained before you open. So, and then it's almost a guarantee, especially if you're new to entrepreneurship, or even if you are an entrepreneur that's been successful and you are in a new industry, you're probably going to make the wrong hires. You're probably going to, not pick the right GM or the right office manager or the right marketing person. And then, so then you have to rehire somebody else and train them. It's just money's just going out. And so that starts to happen. And then you make some of the wrong hires. And then all of a sudden you're like, the revenue's not as high. What's the first thing that business owners do? They pull back on marketing. Like they do the opposite of what they should be doing. If they could just have a crystal ball looking in the future of like, do the smart things, the right things, the things that you're supposed to do, the basics of the business, marketing, have the biggest outdoor signage that you can get, turn on that sign as soon as you can, even before you're even open, put window clings out, like do anything from a visibility standpoint. Like you should be investing a ton into marketing, but that's when franchisees start to pull back. They don't spend as much money on marketing, and that's just a downward spiral. So that first stage, whatever it is in your brand, it might be, the first 6 months, like it was for me, it might be some lower, some higher in different industries. You've just got to know, like, that's the pre-cash flow stage. You are building the asset. You're not making money yet, and that's okay. So that's stage phase 1. Anything else on that before we move on?
No, I think you nailed it.
Attention, franchisors and franchisees. There are 2 really important resources that I want to share with you that will help you avoid costly mistakes and increase your enterprise value. The first is our free Facebook group. It's a community that has over 4,000 franchisees and franchisors in it. When somebody asks a question, they get honest and authentic answers from multiple perspectives. You can join the group for free over at franchisesecrets.com/Facebook. The second resource I want to share with you is if you're a franchisee and you want to be around a community of successful Zs and other brands and in other industries, this is why I created the Franchisee Mastermind. If you want access to the best single and multi-unit owners to know what they're doing, or if you want to be around other multi-brand owners, then you'll want to check out my franchisee mastermind. The reason why people join is they want access to my Rolodex, my connections, to each other. They want a shortcut success, both short-term and long-term. Links will be in the show notes or at scalablefranchise.com.
I got one more thing to say though, Bobby. You had a great analogy talking about surfing. I wake surf behind my boat. I'm pretty good at it now. I got a wake foil, and I've done some foiling before, but not behind a boat. And I did things the wrong way. Like I had my wife gun the boat like you do for surfing. It just goes really fast. It gets you up to 11 miles an hour, and then you just surf the wave. Well, I did that on the wake foil, and the wake foil is like being on butter with this, like, on an airplane. It just whipped out from under me, and I'm like, oh, I need to do it a second time because obviously I didn't get it right the first time. Same thing happened. Lucky I didn't get hurt, but it's like the first time that you're trying anything, you're not going to be very good at it. So wake foiling is probably going to be my analogy for the near future of like the thing that I'm really bad at right now. But let's hit
I,
state.
Real quick, Erik, before we move on, I think that's a great analogy for some people that have been successful in one system and think they're going to have the same success in the next system too. Like go deeper versus wider. And we did a really good podcast on that a while ago. But just knowing like you're still going to have a learning curve. Maybe it's not as steep the second go at it, but when people think that everything's going to go perfect when they diversify and add another brand, like it doesn't always work that way. Even though you knew wake surfing, foil like was completely different. So there is going to be that analogy, I think, that's relevant not only for any franchise you get into, but also down the road if people start diversifying into complementary or adjacent concepts or services too.
Yeah, you're on a board, you're in the water, you have a rope, you are on a board, but the difference is there's a foil under you, and everything's different. The way that you move to maneuver yourself on the water is very different. And I can say firsthand, like I've been a part of a number of different franchise systems, and it's still, I'll be very successful, get into a new one. I'm like, oh, I wasn't ready for this. And I was
Yeah.
overconfident. And I see it with some franchisees too. Some franchisees are part of brands that are just so easy. It's just, or they're part of brands that were easy and now they're hard. Like Orange Theory is an example of that. Like back in the day, everyone was like successful in Orange Theory. You breathe and you put in $500,000, you're doing well with Orange Theory. And times
Yeah.
are different now because the industry's changed. There's things that are changing. And you have to be good at managing a P&L, managing employees, having good retention, all kinds of things you have to be good at today that you didn't have to be good at before. So, we could spend hours on phase one.
Love
All
it.
right, moving to phase two. This is kind of like that stabilization mode. If phase one was like 0 to 6 months, this is probably 6 months, 6 through 18. Again, depending on your brand and you and whatnot, so many different variabilities. But this is stabilization phase. You're not always going to be in like, let's burn money, getting ready for revenue stage. This is the stabilization phase. This is where revenue is coming in and you have the chances to pull it out as a wage for yourself, reinvest it in growth, or just like continue just to make a little bit of money and not reinvest it, and have a low paying job. And some people are happy with that. This is where people make the mistake where they are wanting to build an empire, but they also want to make a ton of money. They want to make a ton of money and build a massive empire and use the investment from the first one to do all of that. Well, at Sola, when we were in growth phase this whole way, we were taking all of our money as we would open up one, make money, invest it in two, and now we had two of them, invest it in three and four. We were not really making a lot of money from a cash flow perspective because we were always reinvesting. And we got to the point where we're saying, okay, either we're just going to stop growing at 12 and start cash flowing and making really good money, or we're going to take this asset that we've built on the balance sheet. The income statement was okay. It wasn't amazing because we were putting so much back into the balance sheet. Now we had this asset that was worth a lot of money, private equity wanted that. And so we sold that asset to that private equity company that bought the franchisor. But that stabilization phase is an important one, and people get all messed up in the mind thinking, I thought I was going to be making a bunch of money in it, but no,
Yeah.
that's the time where they need to either take the money out and be a one store, one unit, one location type franchisee and maximize that, or reinvest that and grow and pull out a bit of money. What else? What else am I missing?
I think as I think of this, like you think of phase one, stage one, whatever it is, you're unconsciously incompetent. You don't know what you don't know. You don't know you're not good at it. In this stage, you're typically consciously incompetent. I'm aware that I'm not great at it. Maybe you're flirting with profitability, maybe you're making a little bit of money to your point, but you're needing more for marketing. Hopefully your payroll is kind of stable. Maybe you're not injecting a ton of capital at this point, or it's less frequently, but you may still be putting money in at this stage. Hopefully you're not. Hopefully you're kind of at that profitability, if not making a little money. But you see those people, to your point, any money you're taking out or making, the business, you haven't earned the right. You haven't earned that yet. Like, try to reinvest, but a lot of people think, oh, I should be making more than my W-2. I'm in year 2 now. Maybe I'm month 13. Man, I put a year into this and I'm not making more. And it's like Rome wasn't built in a day. Like, give it time. And as long as you're building that trajectory, eventually you can build this hopefully into further stages where you can decide to do exactly what Erik just said. You can create a cash cow and we're done growing. We want to keep it here, or you can capitalize on that asset. I joke with any franchise I've been a part of, it's never really been worth it until I sold, no matter what, even if you're cash flowing and making good money. So just be strategic if they are taking out money at this stage, but it's easy for people to get discouraged, to my point earlier. I've been in it for a year, 18 months, whatever the number may be. Like, it's hard. I'm grinding in this. They see revenue, but they don't feel like they're making any money. That's normal. Like, again, the first year or two, you need to have really humble expectations about a business and give yourself a runway. But if you're a high income earner, you're probably not outpacing your income at that point. That is completely normal. Remember, you're building an asset that you're not buying yourself a job. My W-2, if I'm not there, I don't make money. With this business, if you build it the right way, you can have a lifestyle where you're not involved in the day-to-day 40, 50, 60 hours a week and still generating significant income. And that gets easier with the second and third and fourth location. And to your point, Erik, reinvesting, one location of almost any franchise is an expensive job or a hobby. 2 locations is typically a headache. 3 is when you start to get scale and you build those 3 locations up. Well, now I've got financials to maybe put an extra layer of management in place. Now I'm the CEO, not necessarily the person in the trenches on a day-to-day basis. Maybe I can hire and put additional layers of management there and focus more on driving the business forward versus the day-to-day operation. So again, you're starting to maybe return some capital, but you need to be very careful about taking distributions, taking a ton of money out, even if you have a really good month, because it may be seasonal, right? What are you setting yourself up for success for the next 6 to 12 months? That's the way I'm kind of thinking about it at each stage of this.
So if we had built three to six solas, we would have been cash flowing very nice. The income statement was great, but we weren't building to just have cash flow. Cash flow is great. You need cash flow, but we were looking at the balance sheet. We were building the asset. That was more important to us. So once we had that asset of 12 built, then it was decision time for us. Do we now cash flow this or do we sell it? What do some of the partners buy each other out? What does that look like? So, but all of that kind of happened in that stabilization phase. That's when that's a hard stage. You need to spend more money on marketing. And it may not feel like you have a lot to spend, but you need to spend more, not less. That's when you need to have your payroll dialed in. You need to stabilize payroll. You need to understand your KPIs around payroll. How many employee hours per product or per service or per, a revenue, whatever that looks like for you in your business, you need to have payroll stabilized and maximized. And then just start to identify different inefficiencies that you have in your location, in your service-based business. Because this is what separates the great franchisees from the other ones. Like from a financial perspective, not like high revenue or whatever, but from a P&L balance sheet perspective, you've got to keep spending money on marketing. Some people are going to spend money on marketing and not stabilize payroll. Well, their revenue is going to be great. They might make the podium for the franchisor for having the highest revenue, but if the payroll's not in line, then who cares? They're not making a bunch of money. And these great franchisees are always looking at, what can I do better? How can I be more efficient in these different things? And I think AI has a lot to do with that. And that's also something you could be talking to your franchisor about, is how do you help us get more efficient in our locations? Maybe it's a call center, maybe it's an outsourced call center vendor, maybe it's some marketing help, maybe there's a pooled content library. There's a lot of things that can help you with efficiency, so you're not just doing it on your own. Also, let's say the franchisor doesn't want to help you with anything. Let's say you pick the worst franchisor in the history of franchising. I got a couple going through my head right now. None of them, they're all in food. But let's say, well, I'll just say it because they've got so much bad press. Quiznos. Let's say you're with Quiznos, because I don't even think they're around anymore. They weren't helping you at all, and they were probably hurting you. Well, like, if you're a part of a brand that is making it more difficult for you, just lean into the franchisees. Do things together. I mean, think about yourself as an entrepreneur. What would you do if you didn't have a franchise system? You couldn't blame it on anybody but yourself, and you would be around other entrepreneurs that would probably point the finger back to you. Like, you are in that stabilization phase. Don't let up on marketing. Get more efficient with everything, because the next phase is a great one. Anything else to add on that stabilization, Bobby?
Yeah, I think, going back to that, you made a really good point of like leaning on the franchise system. And I think that's either way, even with the franchisors, listen to the franchisees that are performing in your system, right? Because there's always going to be top performers and bottom performers. Like, again, do bottom performers have valid things? Absolutely. However, I don't, I'm not going to learn a ton from them. Who I'm going to learn from are those that are beating me. And to your point, you're starting to recognize what those KPIs are and where you rank. Where are you? Because now you kind of have a feel for the business. You're getting better at doing it. You know how to run it. You can inspect what you expect. And now, to your point, to this next stage, well, then now maybe I'm putting a person in place. Maybe I'm optimizing at that point. But yeah, leaning on the top franchisees, and just, again, I've seen franchise systems with it. There's a couple toxic franchisees. Like, I've seen it in cases where they're excommunicated. Like, nobody talks to them. And it's just because, hey, every time we talk to you, you just complain. And we're focusing on solutions. Like, what can we do to make this, drive it forward for everyone? And candidly, those franchisees sometimes are the biggest strain on the franchisor, which means that takes resources away from me if I'm a good franchisee. I don't want that person on my team. Nick Saban said, A players don't like B and C players. Like, to me, I'm focusing on the A players and what can I learn from them and how can I grow? Regardless of what the franchisor is doing, there's always something to be learned from other franchisees, and someone's going to be better than you at some aspect of the business. Lean into that during that stage as well, too.
So stage 3, phase 3, whatever you want to call it, we're just kind of, wanted to talk this through. This is the first time that we're actually kind of talking this through, but we think it's really important. This is like the optimization stage. Again, we kind of took this from what Greg Nathan was doing, and then what we're seeing some of the better franchisees out there and how they've grown, combined with my own experience as a franchisee. But it's that optimization stage. And you might want to say that if phase 2 was up to month 18, this is 18 to 36. 3 years into it, this is when you're optimizing it. The tail end of, the last year and a half of 3 years, this is where you're tuning in the machine. You're not necessarily building it anymore, because you should have built it up to this point. This is about you going from that operator where you were doing everything. You were the person that would get the phone call. You're the person that everybody knew. You were hands-on in the business. Like, this is where you start to go to semi-absentee. This is where everybody wants to get to, but they don't want to wait 3 years. They want it on month 3. So
Yeah.
maybe there's some unicorns out there that are month 3, but I'm talking, this is from what I've seen as a franchisee myself. So you're more of the manager, and then you need to transition from manager to kind of like the one that is just overseeing. This is when you like what Michael Gerber was talking about in his book, The E Myth. You're working on the business, not in the business. So the first two, you're working in the business. This is when you start to work on the business. Your systems are refined, your team is stable, it's strong, income starts to match like what you were making at your um, salary position before. Like this is when all of that starts to come into picture. You can see the light at the end of the tunnel. This is really what you're building for. Again, this is what most like wide-eyed people getting into franchising want to happen month 3, not year 3. And I've seen it happen a lot of different time frames, but just trying to give some type of indication of what that optimization looks like. Bobby, I'd love to get some of your thoughts around this.
Yeah, I mean, this is when you start to make real money in a lot of cases when you're in that optimization stage. And like you said, it can be faster for some, longer for others, but usually it's within, year 2 and 3, right? That's again, the skiing analogy. Now I know what I'm doing. If I had to use my analogy, now I'm consciously competent. I know what I'm doing, but I still have to focus on it, right? I'm still fine tuning and where can we, it's not, I can't run this business in my sleep yet, right? That's the next stage. But this is where you're looking at, hey, maybe I'm starting to make good money. I have consistent draws or distributions, predictable income. Um, you're buying back your freedom at this point. Like you said, you went from operator to manager. Now I know how to inspect what's going on because I've done it myself or I've been involved more than maybe I need to be today, but I'm still looking for ways to fine tune this and make sure that we're maximizing efficiencies, optimizing, looking at KPIs. Maybe now I want a much smaller deviation between the top producers and me, or the system wide. I want to make sure that I'm at or above because there's franchisees that are younger that are bringing it down. I want to be above those key performance indicators are operating better than. And this is really, in my opinion, when you start to say, okay, now I'm finally earning for the risk that I took the first couple of years. But again, to your point, everybody thinks, oh, first 6 months, or they hear the unicorn story or the one franchisee that worked 80 hours a week in the business and they're generating crazy profits. Like that's not the norm. Like we're probability people. The probability of success, let's look at probabilities. And this is from a probability standpoint, when those franchisees that are executing in a good franchise system start to optimize and make that money. And now they're starting to look at ways, okay, can I outsource this? I know how to do it, but should I be doing it? Right? Can I pay somebody to do that? Does it make more sense to buy my time back? And essentially, like you tend to see at this stage is that's when people are kind of either deciding or starting to decide, do I double down? Is this, have I had my fill? Like you're starting to see that, like I've developed the locations. Do I want more? Is this where I'm going to stand? Am I happy with this? You get to see where people's gut is on how gritty they want to be and what type of empire they want to build. There's nothing wrong with building a great cash flowing operating business. A lot of people, they're perfectly fine with 2, 3, 4, one location, whatever it may be. But then you have those empire builders, which are kind of the unicorns for franchisors of, I want to build this into a 10, 15, 20, 30 unit operation for me that I can create generational wealth. And this is something I can spend 100% of my time on, make significantly more than what I did in my W-2. You start to see that is now that we're returning some of that capital, what are you going to do with it? You can go live a fancy lifestyle, or are you going to reinvest it into expanding your portfolio or your empire?
This is, I mean, by the way, this is these stages, these phases are more dependent on how you as a franchisee are performing versus a timeline. In other
Right.
words, is it going to take you longer to reach the optimization stage if you like were late getting your sign up, you weren't out in the community building relationships, you had a very weak grand opening, now you're trying to make up for it. All of those things in the early stage in phase 1 have an impact on the speed that you eventually get to phase 4 of like scaling or exiting. So that's why it's so important. That's why it's the hardest time to be able to spend the money, have the right mindset. And that's why Greg Nathan says people, once they have the money going out, it's the fee stage. And it's a very difficult stage. And that's where you have to be in the zone. Now, just in the real world with me going back to Sola, because we did that in 5 years and exited. We in the first, we were in stage 1 of like investment stage on 3 locations really before any of them were producing any kind of money. So we were all in on 3 locations in lease signing, some stage of construction, or the first 6 months of opening. Like we had 3 of them going on. We didn't wait to get the second one and the third one open up and see how they did before we decided we were going to build another one. And the reason we didn't wait, because that's not what we signed up for. We signed up with a development plan to open up 12 of them in 5 years. That's what we signed up for. And so we had to open them up on schedule. And did things always go smoothly? Absolutely not. Did funding dry up when SBA stopped funding? 100%. Did we have to find other resources? Yes, we did. Did we go all in on 3 versus just 1? Yes. And then one of them was average, one was below average, and one of them was exceptional. So we continued to go, but that was the plan. If we didn't, if like all of them were dogs, the 3 that we opened up were dogs, then we would have just stopped and we would have eaten the franchise fees, because we paid the full franchise fee for all of them. We would have stopped. It's on me. I didn't make it work. Or worst thing that could have happened, Bobby, think we had a great payday. Worst thing that could have happened is, let's open up 1 location, see how it does. If that had been our second location, which was Huntington Beach, which is our worst performer, we would have never opened up 11 through 12. We would have
Right.
never had that big payday. And I guarantee I would have blamed the franchisor for that. So like, so just some perspective as we're talking about this. But back to optimization,
real quick, Erik,
this is your return on capital window. This is, yeah.
Oh, it's really funny you say that, because same thing with Complete Nutrition. So our first location opened in January, and we had 2 more locations open in April. So we opened 3 locations extremely fast. And one of them was the Battleship, as we called it, top producer, one of the top in the country. One of them was still probably top 25%. And then we had one that was probably bottom 50%. And that's a really good point, because had we opened up that last one in the beginning, we would have never opened more. So knowing that sometimes it was the manager, sometimes it's the market, sometimes it's the parking. At that location, the parking was difficult. It was more of like an outdoor shopping mall that we thought was going to be great. It wasn't as good. It was always tough to get people in there. So having that mentality of like, the quicker you can scale for most of these, yes, it's going to cost more money, but the more you're going to find efficiencies, and you're going to find what is normal. Not, this is the outlier, my bad one's the outlier. Whereas the other 2 were actually doing well above average. So had I opened that one first, we would have missed out of tons of opportunity, and then never grown to 5, 10, 15, 20, eventually 60 plus locations between openings and acquisitions, because of one bad experience. So I love that story. I think that's really relevant to a lot of people listening.
That's good perspective for me too, because if that Huntington Beach location would have, that was an outlier for us as well. We didn't have, in the other 11 weren't anywhere close to that bad. We had one other one that was a slower start, but it was super stable once we got it going. And we learned things that we did wrong. Franchisor was telling us to not lower prices. We lowered prices, and that hurt us long term. All right. Last thing about that optimization stage. This is when you're thinking about hiring someone to do what you do. Like you might not do it. You might do it sooner than later, but you have a good picture of what the business is going to be making. And you can either, let's say it's making $100,000 and that was your salary before. Now you can pay yourself to work in the business for $100,000, or you could be like, I'm making more money at my day job, or I just want more freedom. $100,000 isn't a make it or break it for me. I want to hire someone, maybe someone even better than me, and pay them $100,000, where you are making, like, you're back to 0, but now you are building that asset. And I would argue you're building a greater asset because it's not revolving around you. So that's the stage that you start to think about some of that. All right, Bobby, we're going to wind this down with phase 4, scale or exit. Like, this is what you've been building for. Like, this is year 3 through 7. And that, I mean, we sold at year 5. So that's why, like I'm saying, year 3 through 7, there's an exit depending on how much you've scaled and built that asset. It's, generating a good income. It has good resale value. There's buyers out there for it. But you are no longer the person that's doing everything, holding everything together, because you hired that key person that is working on that business without you, doing the day-to-day stuff. You're doing more higher level stuff. Like, this is where you have options. You can continue to scale smartly, or you can exit. Any thoughts on this?
Yeah, I mean, I think to your point, before this, not a ton of businesses are worth a ton of money. And up until that point where you start generating consistent cash flow, if any buyer, they're going to want to see a couple years worth of tax returns, P&Ls. Like, they're going to want to see, what is this business truly worth? Because it's typically a multiple of an EBITDA or cash flow, whatever it may be. Um, this is where it starts. You built the value. You're maybe generating a significant income, and like you said, like, now my choices open up. Now it's, do I open more locations? Do I just sit on this as my cash cow? I got a good operator or, person in place and create some the redundancy. So if that person leaves, I can start like making sure I have a next in line and deep bench. Or like, do I sell? And the beauty of franchising, and you mentioned this, I mentioned this, franchisees trade, they buy and sell from each other a ton. And that's a benefit, because if I'm trying to sell my Bobby's XYZ franchise, in a lot of instances, nobody knows how to run that business. Whereas when it's a franchise, it's a common system. They're running the same playbook already. They're going to say, let me see your P&L. And that sale is going to be significantly faster than going and finding somebody on the outside that has to be approved by the franchisor, right? They have to go through the discovery process. They have to be approved. And then they have to learn all about my system versus somebody who already knows it when I'm buying and acquiring. And you could also start looking at opening additional locations or acquiring. That was our strategy. We acquired more than we opened, and there was nothing wrong with these models. Like, the market may have not been the best, but we would come in and implement our systems and processes because it was a bad operator. So again, for those people who are talking, well, this franchisee is struggling. Is it the operator or is it the model? If the vast majority of franchisees are happy and doing pretty well, maybe it's the operator, right? Maybe there's nothing wrong with that business, and those can be absolute fire sales. I know some instances we paid for inventory, we paid for $1 for the lease. Like, it was literally, we got into a couple $100,000 investment for less than $100,000. We already had the team and infrastructure and playbook in place. I would promote a manager, send them down there, and go down there for a week or so, decide if we want to keep the employees or not. And that was a huge opportunity. So you basically are reallocating your time to growth, freedom, or in some cases, that's where you start looking at new ventures, right? For businesses that are mature and maybe there's no territory to buy, it's sold out throughout the country. Well, maybe they start looking at complementary or other businesses to get into. But you have options because you've built the infrastructure. You're generating significant cash flow at this point, and the business is truly valuable, not only to you, but to somebody else. And you have options at this stage. So, I'd call it the harvest window, if you will. You get to reap what you finally sowed for so long. You get to harvest what you've been doing, and you choose on how you want to do that.
It's hard to get to the scale or exit stage. Like, it's really hard to get there, and getting there seems like twice as long as it actually is. But I know franchisees, I've been there in this stage, and it's like, gosh, I don't really want to sell. For the first 3 years, 5 years, I wanted to sell. Every day I wanted to sell. Now I've built this asset, and I don't really want to sell because it produces so much cash flow. And I've had some friends that have sold half of theirs for, 3, 5, $10 million. They've sold half of their portfolio and keep the rest. So you've got a lot of decisions to make, and you're in the driver's seat at this point. But you really do need to start thinking, like, am I going to start something from scratch, or do I continue to double down, or do I just decide to do more investing at this point? There's no right or wrong answer, but this is a really fun stage once you're there. So, Bobby, I know that we could probably spend more time on that, but I would imagine you've probably got to go. Any last thoughts as we wrap things up?
Yeah, I think just, really, is people are valuing this, like, the mindset of short-term income versus long-term wealth. Don't get into franchising if you're thinking about short-term income. Just don't. Go take a job, buy a cash flowing business already, because that's going to be better. It's going to cost you a lot more on the front end, but there is going to be a ramp up period. that is typically longer than anyone anticipates. You've said it multiple times. I've said it. Most of the guests on your podcast have said it. It takes time, and you got to be strategic with your timing on when you're starting to take money out or when you're growing, not emotionally. You can't be emotional about it. At the end of the day, you have to focus on what is strategic for my growth stage and my long-term plan. And then think like an investor. Don't think like an employee of like, how much money can I make in year 1 or year 2, or how much can I take out? How many vacations can I take? I don't want to work that hard. I want to spend 5 or 10 hours a week on the business. Think like an investor of, what do I have to do to get to those stages for long-term? And then reverse engineer it, build out the systems, the processes, and the people, and know that things are going to break. They're going to break. There's going to be weeks that maybe you're used to spending 5 or 10 hours a week in the business on year 5, that somebody strategic leaves and you're going to have to put 40 hours a week into the business. It's just going to happen at some stage and point. But don't buy a franchise if the buck stops with you and you're like, I've got full-time, I've got family, I've got a full-time, I've got other rental properties. That's my passive income. Like, don't buy a franchise if you're not able or willing to go all in, because the buck stops with you as a partner. If you have bad employees, franchisor can't do anything about it. If you're not executing the system, the franchisor really can't help you there. They're going to give you the playbook and tools. You have to execute, but action and execution equals results. Results don't come. The only place before where success comes before work is the dictionary. So you got to put in the work first, and then you get to reap the benefits. But it's going to take time. So just always think like, am I behaving like an owner, or an operator or an investor? That's going to change throughout your course of this. But you got to be reflective of like, where am I at in the timeline in my life cycle? What is my long-term goal? And then reverse engineer it and leverage the resources you have, but be resourceful with them. The most successful franchisees, business people I've seen, they never have the most resources. In a lot of cases, they actually have a lot less resources, but they're extremely resourceful of what they do with it. They're problem solvers. They figure it out. Like, that's the type of person you have to be to get to that scale and exit stage. You don't get there by being an order taker and showing up and just say, well, I showed up, right? I should be able to scale this. The Orange Theory analogy, there might be a couple of those unicorns, but 99% of franchises, you got to put in a ton of work to get to that stage.
All right, Bobby, I'm getting ready to go on a 3-week European vacation, but you are going to be the new podcast host. You and Jeff can handle things when I'm gone.
Yes.
Well said.
I love it.
All right. We'll let you go. Thanks for coming on.
Appreciate it.
Thanks for listening to the Franchise Secrets podcast. Links to everything can be found over at franchisesecrets.com. And if you want my help with anything from starting your own franchise to growing your current franchise business, please visit scalablefranchise.com.